Welcome to the market analysis for July 2017. My name is Barney Hawkins and I'm Investment Director at True Potential. I'd like to look at how the markets have performed over the last month and also examine some of the key themes affecting our fund managers at the moment. In the UK, the indecisive election result and Conservative Party manoeuvrings to form an alliance with Ireland's DUP have played on investors' minds. Speculation that the government's slender majority could herald a softer Brexit helped cushion sterling weakness, but the general election has undoubtedly prompted questions around the strength of the UK economy. That said, company fundamentals continue to be positive, and the weak pound has helped exporting companies to remain competitive internationally. Looking at performance, the UK stock market suffered no immediate reaction as a result of the election outcome. This partly reflects the fact that the UK market is already unpopular with overseas investors, and so there was no negative lurch downwards as so-called hot money was withdrawn from the market. However, over the second half of the month, UK equities did pull back a touch, losing 2.5% after delivering impressive returns of over 4% in the previous month and 4.7% year to date. In marked contrast with the UK, Europe has become more politically stable, with the election of Emmanuel Macron as the new French president. His obvious support for an integrated Europe has improved confidence across the Franco-German nexus, and with the ECB continuing its program of low interest rates and quantitative easing, consumer confidence is high. For European businesses, this provides a welcome backdrop against which to invest and grow their operations with a degree of certainty and confidence. European stock market returns have been excellent in both local and sterling terms so far this year, but the past month has witnessed something of a pause for breath. Returns were down 2.1% in local terms, although the strength of the euro pared back the loss to 1.5% for UK investors. The region continues to be well supported by our managers, who cite abating political risk, solid company earnings figures, and relatively attractive valuations. In the US, the key event last month was the decision by the Federal Reserve to raise interest rates by 0.25%. The Fed also announced that later this year it would begin to reverse the process of quantitative easing, effectively selling back into the market the $4.5 trillion worth of Treasury stocks and corporate bonds it has been buying for the last 9 years. Although this announcement does represent a watershed in the recovery of the US economy since the 2008 financial crisis, the markets had been anticipating such a move at some stage, and reaction to the announcement was relatively muted. Of more importance to the day-to-day movement of the market is the tech sector, where investors have been taking profits following a very good run this year. Over the month, US equities were up 0.8% in local currency terms, the weakness of the dollar pulling this back to a slight fall of 0.2% when converted to sterling. The best performing market this year has been Asia-Pacific based equities, and last month was also strong, with the region returning 1.9% in local terms and 1% in sterling terms. The region's economic backdrop is encouraging, and while there are concerns about a growing credit bubble in China, the outlook for economic growth and corporate earnings remains positive.
Hello, ladies and gentlemen. Welcome to today's review of the True Potential portfolios. My name is Chris Leyland, and I'm going to spend the next few minutes talking about our flagship investment product, that is the True Potential portfolio range. Firstly, let's start by discussing the performance of the portfolios. What we'll then do is look at what are the key themes we're seeing from our fund manager partners, and finally we'll discuss what changes have been made over the month. Okay, so let's look back at the month of June. Portfolios have lost a little bit of ground. However, if we look further out, performance numbers are excellent, with returns strong in all risk categories, and that's with over a 30% return since launch seen for the aggressive portfolio. Looking more in depth at the underlying funds that make up our portfolios, some of the best returns have been seen from UBS and Goldman Sachs. Starting with UBS, performance has really picked up during 2017, with the style really adding value within the model portfolio structure. Performance has been helped by their allocation to their own currency fund called CARS, which is a real diversifier within the funds and arguably offers genuinely uncorrelated returns to equity markets. Moving on to Goldman Sachs, the True Potential Income Builder Fund has benefited from being fully hedged into sterling in a rising sterling environment. Over the month, their stock picking has worked well, trimming their exposure to the US tech sector ahead of its pullback, leading to a good outcome. Moving on, as you know, we speak to our fund manager partners at least monthly, looking for key themes and tilting our portfolios towards these key themes in order to take advantage of them. Overall, our managers are constructive on risk assets in the current environment. They do not foresee any catalyst to systematically derail equity markets from their current trajectory. They're all cognizant that valuations compared to historic levels, they are on the high side, so a short-term pullback potentially could happen. However, they acknowledge that we're now late cycle, but they fail to define how the cycle will end. What I mean by that is they're not predicting any sort of recession. Most of our managers believe that falling bond yields are not signaling economic contraction. They see this as evidence that the market has cooled in its response to Trumpflation. Most see the fiscal stimulus desired by the US president as a 2018 event. If it does happen, this would be good news for long-term investors as it would represent another growth leg. Now let's turn to trading, which has taken place over the month, where a similar theme of favouring stock picking for higher cash positions followed throughout. Within the Cautious and Cautious Plus portfolios, Schroders has been reduced and the proceeds split equally and placed in the True Potential Close Brothers and True Potential Allianz funds. We feel that at this stage in the current market cycle, there's more opportunity to benefit from selective stock picking rather than being wholly reliant on aggregate prices. Close Brothers are stock pickers and have a greater ability to navigate valuation risk. Allianz are particularly adept at managing volatility, using momentum indicators as a signal to add and reduce risk as appropriate to the circumstances. The decision to reduce exposure to Schroders is based on their large cash balance waiting to be invested into bonds at a time when growth is potentially slowing and yields appear to be in a trading range. In addition, their value bias should be more appropriate as we move into next year and fiscal reflation reemerges as a theme. The Barnes portfolio follows a similar theme. However, rather than adding to Allianz, we've added to the True Potential Goldman Sachs Income Builder Fund. The Goldman's fund is fully hedged, thus reducing currency risk should we see sterling strengthen, and Goldman's have proven themselves to be excellent stock pickers. Within the growth portfolio, the True Potential 7IM fund has been reduced, with the proceeds switched into the True Potential Close Brothers fund. Looking at the rest of the True Potential portfolio range, allocations have been kept the same, with the optimization of the factors continuing to be paramount within the portfolios. The portfolios were constructed to take diversification to the next level in what is an ever-changing world, with the objective of improving the risk-return outcome for investors. The portfolios not only diversify by asset class, geographic region, but now also by fund manager style. We call this blend of manager styles advanced diversification, and this is a way for investors to manage risk and to navigate through any uncertainty. Okay, thank you very much. I'll speak to you next time.